Well, after a tumultuous Monday, we did have a nice snapback rally here today, as most U.S. market indices were up over 1%. However, it wasn't enough for us to turn the posture from bearish back to bullish. So we await further data to see if the bulls can continue on today's bounce or whether the bears remain in control of this market. What we do know is from a sector perspective, utilities and real estate are the only areas that continue to have a bullish posture. And of course, the reason behind that is their interest rate sensitivity, and they're just simply reacting to a plunging U.S. Treasury interest rate environment right now. We also want to take a look at a bearish trade setup within the struggling retail industry. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 6th, 2019. First of all, if you're new, welcome aboard. Go to YouTube, click subscribe. While you're over there, check out our description area where you can sign up for our email distribution list. Also, make sure you're following us on Twitter. My handle is @BrandonVanZee, and we appreciate those of you that click like and retweet of our Market Outlook related posts, which we usually pin to the top of our timeline. Lastly, we do have a presence on Facebook, and we'd invite you to join us at the group embedded in the logo in front of you. All right, with that, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us, and this will just allow us to see all four of the major U.S. equity indices side by side, so that way we can kind of get a sense of whether they're all correlated to one another or whether there's any slight differences. Right now, obviously the concern of the market regarding the China-U.S. trade war that has escalated here in recent sessions kind of took a back seat today as we caught a little bit of a bounce. You can see the S&P 500 was up 1.3%, the Dow Jones was up 1.21%, the NASDAQ Composite was up 1.39%, and the Russell 2000 was up 0.99%. So healthy days all around. You can see that it was a bigger than average range day on the S&P 500 and on the Dow Jones. Remember that these labels up at the top of this chart 4B will change from orange to blue depending upon whether there was an above average range candle or not. And so we did have above average ranges today on the S&P 500 and the Dow Jones. However, slightly smaller than average ranges on the NASDAQ and the Russell 2000. Now, as you can see, we remain in a difficult spot, at least if you want to be bullish, which many of you are, whether it's through your 401ks or just your own stock picking abilities. Right now is showing a struggle on the chart. As you can see, we remain in bearish territory. In fact, when I did this video on Thursday, we were already in a bearish territory at that point in terms of the posture. I should be careful with my language there. We're not technically in a bear market or anything like that, but our posture, according to the Market Forecast Technical Indicator, which you can find over on the TD Ameritrade related resources like the Thinkorswim platform, does suggest that the green line, which is deemed the intermediate line, is in a bearish posture right now. And that has been the case ever since this candle back here on the 1st of August. But what has changed in the last couple of sessions is you'll note that the background color of the chart has gone from a light pink color to a dark pink color. And that is a reminder that we've gone from a weakly bearish posture to now a strongly bearish posture, despite the bounce back rallies that we've had here today. In addition to that, you'll notice that our moving average is no longer supporting the notion of the path of least resistance to the upside. Right now, if you're looking at this 30-day moving average, note that the color changes have been taking place here within the last couple of weeks. We went from having a green moving average to a yellow moving average to now a red moving average. And as a reminder, that red moving average basically allows us to quickly verify that price is below a falling moving average. All else being equal, that moving average could then be used as resistance as this market attempts a rebound back higher, as opposed to when it's traveling up. Oftentimes that moving average can be used as support. So if you're in the bearish trader mindset right now, you probably appreciate that. And so we'll take a look at that and see how that will affect us going forward. One thing I do want to point out, despite all these charts looking fairly similar and having that strongly bearish posture at the current time, according to the intermediate line on the market forecast, I will also point out that this market sentiment line continues to rise on all four of those charts. So remember, we don't discuss the market sentiment line all that much during these presentations because this presentation is mostly geared towards those of you that are a bit more active with your accounts. But the market sentiment line is going back a much further amount of time backwards to try to get a sense of whether truly longer term investors still see positive posture, and right now that is the case. But obviously the longer that we have wear and tear in the market here in the, let's say, the coming weeks and months, eventually those market sentiment postures will start reverting back lower once again as well. So we'll keep our eye on that, and as we see changes, David and I will do our best to notify you of those changes. And by the way, big thank you to David for doing the video last night unexpectedly from San Francisco while his family was out visiting Golden Gate Park. So I think it would be a wise idea for those of you that appreciate that to let him know, that should not be the expectation that he would drop time during his vacation to spend a few hours producing a video and uploading it and all that. I'm sure most of you, when you go on your vacations from your careers, probably were not doing work on your vacation. So again, big thank you to David for that. And if you want to shoot him a quick note of appreciation, his email address is david@marketscholars.com. He should be back in his full swing of classes as soon as tomorrow. In fact, let's take a quick moment to kind of show you that on the internet here. A reminder that the upcoming events will be listed here if you're looking at the Market Outlook video. His options inventory trading class is next. You can also see that if you hover it over your trading rooms icon at the top of the Market Scholars website. So I taught my dividend growth investing class earlier today where we talked about the financial sector and try to scoop up some value out of some recently beaten down areas within the financial sector. And then I'll be talking about my strategy lab swing trading class tomorrow at 2 p.m. Eastern time for those of you that are premium members of Market Scholars. And remember, you can sign up for our services now by checking out our services tab up here at the top and checking out our different pricing levels that we have available to you. Thank you again to everybody who clicks like and retweet on our tweets. Also the thumbs up on Facebook. That goes a long way in helping us spread the word about Market Scholars. Also, while we're over here, I thought it was kind of interesting. I saw one tweet today that did catch my eye. This is from Charlie Balello, and he mentioned that the S&P 500 was down to 26% of stocks above their 50-day moving average, and that is the fewest since January, entering oversold zone where you tend to see short-term bounces. Now remember, we have not yet been seeing the oversold cluster signals here, according to the market forecast technical indicator that David and I focus on for this particular presentation, but there could be other statistics and data out there that suggest that perhaps we're due for a bit of a bounce here. And that was one that certainly caught my eye because it was not my expectation. I figured that in May, remember we spent an entire month of May in the doghouse in the stock market. What we've been experiencing here thus far in August has really been only going on for the last week or week and a half or so. So it has not been, consistently violent to the downside, even though we have had some aggressive sell-off days. But what he is noticing is that the percent of stocks above their 50-day moving average is actually at a lower rate right now than what we saw at the end of May, and it takes us back to January where we are experiencing some difficult markets as well. So, you'll start seeing a lot more of these statistics hitting Twitter out there as market participants start seeking out levels where they're comfortable owning stocks again, and that's one of them that we can put in our hat as a slight feather in our hat there. Also, while we're over here, remember I do the sector selector on Fridays, and so this Tuesday video is the first time I get a chance to share it with a wider audience here. Remember, the true reason I produce the sector selector is for my Monday top-down trend trading class, where we use it to make selections. This is the upper half of the graphic that shows you the transition of sectors. The bottom half of the graphic that's available to premium members of Market Scholars is what we use to choose our stock selections as we're managing our top-down trend trading portfolio. But anyway, wanted to show you some of the transitions we're seeing from a sector rotation perspective here. And again, this is as of Friday night's close, and so it would not have included the movement that took place yesterday. But nonetheless, you can see that even on Friday, we were starting to see a major transition towards more of those defensive areas. In fact, look at utilities surging from second to last on the bottom to second best on the top on our week-over-week rankings. And again, that didn't even include their outperformance yesterday on a big down day for the general stock market. We also saw real estate surging. So real estate is kind of this purple ball here. It was 9th place the week before, and then last week's ranking, it went all the way up to number 4. Healthcare is also a bit more of a defensive sector, and it went from number 4 up to number 1. And then even the staples did track higher by 1 ranking from number 6 to number 5. So, it should be fairly clear here that the market is transitioning, or at least has been transitioning recently, towards the defensive areas, the defensive sectors. Meanwhile, the cyclical areas, those that are a little bit more subject to the whims of the trade war headlines, are the ones that are struggling on a relative basis. So that is kind of where you're seeing positive and bullish movements from a sector perspective. Let's get back on track with some of these other charts now, and let's take a look now at our chart 4C, and this will be our 3 green arrows chart setup. Now, as of right now, all of our charts actually have 3 red arrows. For those of you that are trading bearishly, perhaps that's a good thing. And remember, it helps to stay sharp on both sides of the coin, which is why we did the bearish trade on Netflix in my video on Thursday. Remember, when you see 3 red arrows like we have right now, that can actually benefit part of your trades. Now, more of you naturally are going to have more bullish trades than bearish trades, just because in your 401ks you don't have an ability to short stocks and do different things like that. But for your more active trading portfolios, it does make sense to react to what the markets are telling you. And right now, the markets are in a foul mood, and this is just one more sign of evidence of that, where we do have bearish conditions according to the 3 green arrows methodology. Now, that 3 green arrows methodology is looking at 3 different technical indicators. One of them is the 30-day moving average, which is that line you see plotted up here with price action at the top. Our next set of arrows is associated with the MACD histogram, which is this kind of area that you see plotted in the middle of the charting area. And then the indicator on the bottom of each of the charting areas is the stochastics. And so right now we have red arrow number 1 up there on the moving average, red arrow number 2 right there on the MACD, and red arrow number 3 on the stochastic. So momentum is negative, path of least resistance is negative, and the bears are firmly in control of the ball right now and unwilling to let the bulls take control. So that is the case with all 4 of our charts right now. We don't have a whole lot of distinction there. One thing I would point out is we have a slight little glimmer of hope in terms of the MACD on the S&P 500 and the Dow Jones. And the reason I say that, note that the bars that we have here are gray on the MACD as opposed to red like they were yesterday. Note down below that the NASDAQ Composite and the Russell 2000 still have red bars. So what happens here in the computer programming language that we use on these customized charts is, if the momentum is picking up steam to the downside, it continues to plot those red bars like we see with the Russell 2000 and the NASDAQ. On the other hand, if the momentum is starting to wane a little bit, and right now we're talking about the negative momentum. If that starts waning a little bit and looks like it wants to start rounding a corner and start heading up, then it starts plotting them as gray bars like we see right there. So as an example, back here on the Dow Jones, note that we had this red bar on the MACD, and it started plotting into these gray bars as these price candles started to produce more positive price action. Let's go ahead and now take a look at our next chart setup. This will be a longer term chart here. This is our chart 4D. And this is our 1040 crossover method chart. And there is something to report here. So first of all, be aware that these charts go back 3 years in length. Also be aware that each one of the candles represents only 1 week as opposed to 1 day like our charts that we were just looking at a moment ago. So the thing that I wanted to point out was down here with the Russell 2000. Let me right click and go to maximize sell so that way you guys can see this a little bit better. But as of this exact moment in time, we are starting to get a death cross on the Russell 2000. Now that does come with an asterisk, and that asterisk is the fact that we are still early in the week. It's only Tuesday. We've all seen how quickly these markets can turn on any random tweet coming out of the White House. So as of right now, we do have a bearish crossover, and what I'm referring to on this particular chart is our 10-week moving average that is plotted in orange there versus our 40-week moving average, which is plotted in blue. And you'll notice right now at this moment in time that orange line is down below that blue line. You can see that even better down below here. Remember that this MACD2 lines that we have established on this chart will basically show you whether there's a crossover or not if you can identify where the black line is versus the pink kind of flat zero line right there. And right now you can see just barely that black line is just barely below that pink line. So in other words, we have crosses that are taking place on the moving averages themselves. Now again, this is using a weekly candle, so that's why I'm stressing that. It's only Tuesday, and if the stock market does rally furiously by the end of this week, it is possible that this bearish crossover, or this death cross, as some of you will refer to it as, does not exist. So I'm just merely pointing it out as a heads up right now, even though it has not been solidified in stone quite yet. But come this Friday, David and I will be sure to let you know one way or another whether that actually did occur or not from an official capacity, because remember, as of Friday, then it will be locked in stone because that weekly candle will be closed for business. Right now, it's still open for business until Friday at 4 p.m. Eastern Time. All right, so that is the biggest laggard that we're experiencing from that chart's perspective. While we do have some turbulence from a market perspective on the other 3 charts, we don't have anything close to crossing over of the moving averages themselves. All right, let's now take a look at some 12 grid analysis, starting with 4E, chart 4E here. For those of you that are premium members, remember you do have to be a yearly premium member at Market Scholars to be able to access all of our 34 chart scripts that we have here that are available for our members. And again, seek out our services tab on our website for additional information on that. But this first one is going to be chart 4E, this first set of 12 grids here. And remember, the background colors of these charts will tell us whether we have a bullish or bearish posture according to the intermediate term line using that market forecast technical indicator. So we're going to have a wide variety of charts here on this first set of 12 grids because this is everything that is not necessarily associated with the stock market itself. Okay, so let's talk about the VIX first, because the VIX has certainly been something that traders have been paying attention to here in the last several sessions. The VIX fell dramatically today. The VIX was down 18% today. That's a big move. Now, before you get overly excited about that, keep in mind that all it did was it took back yesterday's gains. And so we are still trading way higher on the VIX than we were just 1 week ago. As you can see, yesterday's candle actually was a 3-month high. So we are just basically giving back what the VIX had gained yesterday. We are still at elevated levels of VIX above 20. Now, in the old days, back in 08-09, 20 was not considered high. But in recent years, 20 has actually been considered a bit higher than average. And so remember how that affects you from a options trading perspective. It allows you to receive more premium in your sold spreads or your sold puts or your sold calls than you would have received, let's say, a couple of weeks ago down here. And of course, those of you that attend David's inventory management classes on Wednesday, which he should be back for tomorrow, he'll be the first to tell you that yesterday was a day to take advantage of. Yesterday would have been a day where you should have been putting some inventory into your portfolio at those elevated VIX levels. So anyway, That's been one of the big stories of the market here recently. Another big story is what's going on with interest rates. As you can see, interest rates have completely fallen out of bed here in the last 4 or 5 sessions. Where we stand right now on the 10-year Treasury yield is 1.73%. Yes, you heard that correctly. Even though within the last year, we have seen that exact same series of yields be above 3%. So we have fallen not quite 50% in yields, but nearly that much. And the crazy part about it is it still looks generous compared to the rest of the world. If you look at the German Bund market as an example, you're going to find mostly negative rates there and also in other places in Europe. So, it is true that these are awfully low interest rates here in the United States, but they still look appealing abroad. And I do hear a lot of commentators on CNBC or Bloomberg or what have you talk about this idea that, well, China could do the nuclear option. And what they mean by that is they could sell U.S. treasuries. Remember, China owns a significant amount of U.S. treasuries. Well, keep in mind that if China does decide to do that, I have a feeling we're going to be able to find buyers for those treasuries elsewhere. Because again, if you're sitting in Germany and China is willing to sell U.S. treasuries, remember that should put additional supply on the market, which should then send U.S. treasury yields higher. And if that were the case, then somebody sitting in Germany or other parts of Europe that are getting negative rates would probably be there to soak up that excess supply with their own demand. So we'll see if that takes place or not. But right now, what we do know factually is that interest rates have been in a significant downtrend here in the United States and elsewhere across the globe. In fact, that has been one of the themes that I've been trying to identify and point out to you guys time and time again for the last several months right here in the middle of this 12 grid, which is the foreign bonds. And again, I sound like a broken record because I basically point this out every single time, because my goal, when I'm doing this part of the presentation, is to point out what I perceive to be strong trends. And this has effectively been a strong trend for the last, let's call it 2.5 months. And it just continues to be the case day after day after day after day. It seems like BNDX, which does track foreign bonds, continues to go higher and higher and higher and higher as interest rates continue to fall and fall and fall and fall. And you can see that while the U.S. government long bonds have not been as consistent, notice the consistency there with foreign bonds. TLT looks a little bit like a different chart, but it has made up for it in a big way in the last week. Note that TLT has basically exploded off of this moving average and risen dramatically in a straight line higher here. And it was up yet again today, up another 0.8%. So anyway, while the consistency is not as strong as what we saw there with the BNDX, it looks like it made up for it because it kind of drew a 45-degree angle line here. You're probably right back up there now. So while it just went sideways for several months, the move that it's made in just the last week has made up for that sideways movement for those of you that would have been long U.S. government bonds. Other areas of interest here, I would say gold is a big area of interest and one that commands a very strong trend right now. Note that gold hit multi-month highs here yet again today, and so some of those same stocks that I brought to your attention here in these presentations over time. KL is one that I've been keeping my eye on. It's done really well near all-time highs. Other stocks in that area include Barrick Gold. You also have Newmont, or what they call Newmont Gold Corp these days, because those two companies combined. Yamana Gold, Nova Gold, IM Gold. There's a whole bunch of them out there. And they, Gold Fields is another one, Harmony, and those ones are over in South Africa. But, there's a lot of opportunities out there. And remember, the gold mining industry is kind of an interesting one where there's actually only one single gold mining stock in the entire S&P 500, and that is Newmont Gold Corp. Now, part of the reason behind that is the S&P 500 focuses on U.S.-based companies, and a lot of the big gold companies out there globally are located outside of the U.S., so it makes it kind of rare. A lot of other sectors and industries, U.S. companies dominate globally. Gold mining area is one area where the U.S. stocks are a relative afterthought. And so you don't hear a lot of people talking about them. Yet if you dig into the details and you just pull up something like, I don't know, GDX as an example. GDX is a ticker symbol that will look at the senior gold miners. And if you go to their website of that fund company and look for the holdings there, you're going to see a lot of really nice looking charts. And then GDXJ would be the same kind of philosophy, but you'd be looking at the junior gold miners. So as kind of a homework exercise for some of you, I would encourage you to go and just pull up a list of the holdings of those two funds, and you're going to find some really nice looking individual stock charts there. So that, I would say, is another big part of our conversation here. Gold continues to surge. Now, another thing that I think is a bit more concerning is what's going on with crude oil prices. There were a ton of oil stocks that just laid an egg here in the last couple of sessions, whether it's Concho Resources or Apache or Occidental or any of the kind of smaller fly-by-night operators. I mean, it's pretty much across the board. It is true that Exxon and Chevron are maintaining their value a bit more because of their heft, but I mean, it is really, really ugly out there in the oil patch right now. And a big reason behind that is oil prices themselves continue to fall. And whether that changes or not is anybody's guess. But remember, there are differences in commodities. Gold is oftentimes viewed as a safe haven that is not really used for much of anything from an industrial purposes perspective, whereas crude oil is basically taking the temperature of what's happening economically globally. Remember, that's not a U.S.-centric asset right there. It is certainly impacted by all the horizontal drilling in the Permian Basin and up in the Bakken Shale area and all that here in the United States. That has changed the whole paradigm for the industry, as a lot more supply has come on than has been able to in the past as a result of that new technology here in the United States. But crude oil itself is not a U.S.-centric commodity. And so while the U.S. economy seems to be reasonably strong right now, remember that the global economy is struggling on a relative basis. And if globally we are using less crude oil, then it's going to pressure those prices. And so we'll have to see how things shake out there, but there are definitely some concerns in the oil patch right now as a result of a lot of that ugly price action within crude oil itself. Let's now take a look at our next chart setup, and this will be our foreign stock markets, chart 4F here. And as you can see, it's a clean sweep for the bears. There's not one single bullish posture chart on this board. All charts are pink right now. Some of them look worse than others. You can see that some of these areas that I've been trying to identify with you guys here recently have continued to pick up steam to the downside, which is Germany, United Kingdom. Those two really fell out of bed. Notice how they were hugging those moving averages for much of the last 3 months up until the last 2 weeks. And then they've just completely fallen apart to the downside. Note that they are producing oversold cluster signals right now, so it is possible we get some sort of a mini rally out of those, but I don't know how much I would trust that rally. Right now, path of least resistance continues to be to the downside, and you're seeing the same type of behavior whether you're looking at those more developed areas like Germany and the United Kingdom, or whether you're looking at the BRIC countries up above. China, of course, has been front and center of our conversations, and China has completely fallen apart to the point where it's receiving those oversold cluster signals. India doesn't look much better. Of the 4 BRIC countries up at the top, I would say that probably Brazil is the one that seems to be absorbing the blow the best, but even it looks like a bit of a broken chart at this point, where we do have a moving average that's now painted red. In fact, if you look at all of these charts, the only chart where the moving average is not painted red is Israel. And that's the only one where its moving average continues to rise and price is still above it. Otherwise, all 11 other charts are showing the path of least resistance continues to be to the downside. Let's go ahead and check in on the United States now with chart 4G. And this is our sector 12 grid here. And this is what I was mentioning in the intro, that as you look at these different sector charts here, there's only 2 on the board that remain green, and that is utilities and real estate. And if you've been watching these presentations for any length of time, you should be well aware of the reason behind that, and that is what I mentioned just a little bit ago, which is Treasury yields are plunging right now. And all else being equal, if interest rates are falling dramatically, utilities and real estate are the two most interest rate sensitive sectors out of the 11 that are out there. So they're the ones that have the best chance of holding up better than others. And an area that generally struggles on the opposite side of the coin is financials. And you can see that financials have been falling pretty significantly here in the last couple of weeks as the interest rate environment has started to plunge a bit more. But it really does look pretty ugly out there for most of these charts, with the exception of utilities and real estate. So not a whole lot of places to hide out there. Of course, I mentioned gold before, and perhaps some of you that are a little bit more bold might decide to get into Bitcoin and a few of those other areas that seem to be holding up. But from a true stock market perspective, it does seem like utilities and real estate are about the only places that are seeing some sort of resiliency from a sector perspective. All right, let's get into our trade application example for the day now. I am going to go ahead and pull up chart 4A now, and I'm going to pull up a very well-known company. In fact, most of you probably own their products to one degree or another. Now, obviously, it's been a very controversial company as well, where maybe some of you swore them off depending upon your politics over the last year. But nonetheless, Nike remains a globally dominant footwear company. And of course, they've gone on to all kinds of athletic gear, not just footwear. But nonetheless, they have done extraordinarily well over the last several decades to have this preeminent role that they play here today. But as you can see, they have even started to take it on the chin here recently as these trade wars have started to heat up a bit more. Remember, China does a lot of business in Nike does a lot of business in China from both a retail perspective. I've traveled over in China myself and seen standalone Nike stores over there. So I know they sell a lot of footwear in China, but importantly, they also have a lot of factories in China that they use. Now, Nike has been trying to, transition some of its product over to Vietnam or Bangladesh or Indonesia, but China remains an important piece of the puzzle for Nike. And if we continue to have these trade wars between the U.S. and China, it is possible that all these tariffs that we are announcing here in the United States is going to start impacting the bottom line at Nike. Now, they'll still sell a lot of products, don't get me wrong. They're still a very popular company. It's just that their margins might be squeezed because they're going to have to pay more to import that merchandise into the shores of the United States before they can put them in the Foot Lockers and the Dick's Sporting Goods and the Shields and all the other types of sporting good companies out there. And they have a choice of whether they raise the prices of their shoes and pass that along to consumers, which that's certainly their opportunity. But if they feel like the U.S. consumer is not going to be able to absorb those price increases, then it might be Nike shareholders that end up absorbing the blow in that particular situation through squeezed margins compared to what they had been able to attract in the past. So I'm going to do what's known as a bear call spread on Nike here today. Now that we have clearly broken support, we have a falling moving average that's now red, and we now have what's known as a strongly bearish posture from an intermediate perspective according to the market forecast technical indicator. So the trade that I'm going to do is pulled up down below here. And let me show you, give you a little bit more room, what I'm looking at. It's the September monthly contract. That's the one with 45 days left until expiration. We're looking at the 85 strike to sell. You'll notice that that is the 32 delta. So all else being equal, you'll oftentimes find that we sell around the 30 delta as our sold strike in our credit spreads. And that also means that we'll be buying the very next strike, which in this case is the 87.50. So you can see I've got that loaded up down below. I'm selling the 85 call. I'm buying the 87.50 call to create a credit spread of 65 cents. In this case, it's also known as a bear call spread. And what I'm hoping to accomplish with this is to have Nike stay under pressure. In other words, we want their stock price to do poorly for the next 45 days. Now, we can have a little bit of flexibility. So in other words, we can have Nike go up from $81.30 where it is right now. We just don't want it to go dramatically above 85 where we've sold our call right here. So we give ourselves maybe at $3-4 of wiggle room to the upside there. But you'll notice that if I click on confirm and send here, we'd be able to receive $65 for every contract that we would do, and we'd have $185 worth of risk. So what we try to do is get 30% or more return on risk. So if I took $65, divided it by 185, you'll see that that represents a 35% return on risk, and therefore this is an acceptable type of a trade. Also note that the break even on this would be $85.65. So let me go ahead and send that off, and we'll see if we can get filled in the morning on that. But also let me show you here on the chart where that represents our break even, and that would be right up in this general vicinity where you're seeing me kind of circle my mouse. And note that that is also where the downtrending moving average is. So if you have a belief system that that downtrending moving average will represent a resistance area, and if Nike is fortunate enough to bounce up to that area, it will be used as a selling opportunity for others and it will bounce Nike back lower, then that would be another reason why perhaps you would be interested in a trade setup such as this. All right, well, thank you for joining me here yet again. David should be back with you tomorrow, assuming that his travel plans go well. Remember that we continue to have bearish postures across the board, so while today was nice to see from a bullish bounce back perspective, we're still not to the point of feeling truly comfortable with where the trends are taking us. So expect additional volatility as the weeks and the months come on here within the fall trading season, which oftentimes does have more volatility, whether it's August or September or October. We want to stay vigilant, and that's where David and I are going to do our best to support you through these YouTube videos here. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.